So here's a question for you. Using Vanguard's platform in the UK, can you build the ultimate investment portfolio? Can we make something on the platform that gives us pretty much global exposure, very low cost, very low risk, and something that will allow us to grow our wealth over the next 10, 20, 30 years? Currently on the Vanguard platform in the UK, there's 76 funds to choose from. So as a beginner, this can be pretty daunting to have a look at. However, I think I've already made something that the majority of people will find absolutely perfect for them. And as long as your investment timescale is a minimum of 5 years, I think you should do pretty well with this one. So by the end of this video, I hopefully would have shown you what I think might be one of the best portfolios that you can make currently using the Vanguard UK platform, and something that you can pretty much set and forget, super low cost, super low risk, so you can get on with enjoying your life and browsing Wall Street bets. So let's break things down and get straight into the video. As I just mentioned earlier, Vanguard offers 76 funds here in the UK on their platform, so that's quite a lot that we're going to have to go through and work out which one deserves our hard-earned money. They can all be purchased directly at vanguardinvestor.co.uk, and of course they are actually available on some other platforms, whether it's Free Trade or Trading 212 or wherever you like to do your deals. Just search for these Vanguard funds and most of them should be available. But let's be honest, the Vanguard platform is pretty much really easy to use already, and the fees are super low, so you won't go very far wrong with having Vanguard as your platform of choice, because they've already got $7 trillion worth of money under management.
Show me the money.
So let's now run through some of these funds. Across the platform, you've got equities, bonds, fixed income, and of course you've got a couple of managed options. You've got the Life Strategy Fund, and then you've also got the Target Retirement Fund as well. These funds are then further broken down by the region. So of course you've got the UK, you've got Europe, you've got emerging markets, and then also, as I just mentioned, you have fixed income too. For the purpose of this portfolio though, we want full growth, so we're just going to go head on with equities. Right, so put all the bonds to one side, put the managed funds, put the life strategy, put the target retirement funds to one side. How many funds does that leave us with in the equity section? It leaves us with 33 different funds to choose from. Still a pretty big number. So how can we create the ultimate portfolio with these 33 funds? We need to figure out where we're going to put our hard-earned money to watch it grow in the best way possible with the lowest possible risk and lowest possible cost too. To help us figure this out, we're going to use some figures from MSCI. Now, like FTSE and S&P, Standard & Poor's, they're effectively an indexing company who keep track of all the global world markets and will tell us how large each market is by market cap and how much weight you might want to give as a portfolio to make sure you get global exposure to every single publicly traded company. I'll put this on screen now, but currently this is how the world is split up in terms of market sizes. No surprise here that the US market, which is the biggest in the world, makes up 60% of the entire equities market, with some of the world's biggest companies being based there. Unfortunately, after the US, no one really comes close, but in second place we've got Japan with 5.8% of the market, China with 4.14% of the market, the UK just under 4% at 3.72% of the market, boohoo, France at 2.96%, and then the rest of the world fits into 23.79%. So in theory then, a good way to split our money might be based on the size of the market. So for example, in really basic terms, if we just had £100 to invest, we might use those percentages to help us gauge where we put our money. So for example, in the US, we might put £60 of our money. In second place, we put £4 worth of our money in China. In UK, we put £3.72, for example, and so on and so on. The bigger the market, the more money we want to put into it. The smaller the market, the less money we put into it. So if you're following me along here, and hopefully I haven't lost you already, we're going to put more of our money where it counts and less of our money where it doesn't. But of course, we've got no idea what the future returns are going to be like. So we want to make sure that we've got a good global exposure. And now we've got to work out where we put our money spread across these different funds. And of course, we want to try and use as least funds as possible so we can save ourselves some time in the future. Using MSCI again to give us a bit of a hand, we need to split the world up into two different parts. And effectively, they have the developed world and the developing world. According to the MSCI, if we break down the world into two parts of just developed world and the developing world, we get a split of 88% of the equity in the developed world and 12% in the developing world. And I think, in my opinion, this is probably the best way of doing things. Rather than trying to have 5 or 6 different funds across all markets, if we break down things into developed and developing, this might be a good way to get us started. Well, lucky for us, Vanguard have already broken down developed and developing funds, so we don't have to go down into each different individual company, and we can actually pick and choose one fund for the developed world and one fund for the developing world. So in theory, for the ultimate Vanguard portfolio, here are the 2 funds you'll need to get you exposure to the whole world in the correct weightings dependent on their size. So the 2 funds that I would choose are the following. The first one is the FTSE Developed World ETF, which is VEVE, and the second one is the FTSE Emerging Markets ETF, which is VFEM. These both have very low charges, as you'll see, 0.12 and 0.22 respectively. And make sure you go through all the key investor information documents. That's all up to you to make sure you do your own research. but all the information you need's on there. So now the juicy bits. We've got 2 funds that we can cover the whole developed world and the emerging market space. How much money do we choose with each? Well, if we go back to what we just said about the MSCI and how the market is split up at the moment, with 88% of it being concentrated in the developed world and 12% being in emerging markets, that in my opinion is probably a really nice way of how we should split up our investments. So let's go for 88% in that developed world fund, and let's go for 12% in the emerging markets fund. Nice and easy, right? Now in terms of average cost between the 2 funds, if we split things up like that, it only ends up costing us 0.13% to do it in that way. And then of course, if we add that onto our annual account charge at 0.15%, we're looking at a really, really low fee of 0.28% across the year for our entire account charge, which let me tell you is extremely cost effective. There's plenty of funds out there which will charge you even up to 1% for owning them. So having that cost to cover everything is super cheap. And costs and charges and fees, remember, make a huge difference over the lifetime of your account. Once you've been invested for 10, 20, 30 years, and as your investment grows, remember, costs and charges can take a huge bite out of your investments. So if we make things really simple and say we might have £10,000 to invest, we would put 8,800 into VEVE, and we put 1,200 into VFEM. And hopefully, if my amazing maths is correct, we should get to £10,000 total investment. Now, of course, you'll have loads of options in the way you might want to invest in these funds. Of course, you might want to go with lump sum payments here, but I suspect that most of you will probably want to go down some kind of monthly route as you get paid putting money into the markets. Now, the minimum monthly payments on these funds, of course, is £100. And in order to get that weighting, you'll have to work out yourself the best way to do it, whether that be investing £100 into the emerging markets or £100 first into the developed world and slowly catching up with the emerging markets. That's completely up to you. However, we're not finished yet. Hold your horses. That might be one way to make the ultimate portfolio, but can we make it, and can we challenge ourselves even more to make it into just one single fund? And I genuinely think that Vanguard can probably help us here and make our life even easier, so we don't even have to worry about balancing up our investments. And I think the additional very small fraction of cost might be worth it. So enter from stage left one of the most popular funds on the platform, the FTSE All World UCITS ETF, which also trades under the ticker symbol VWRL. As the name suggests, this one covers the whole world, so rather than ourselves trying to have to make up individual funds and choosing the emerging markets and the developed world, the FTSE All World Fund already does all of that balancing for us and means we just have to manage one investment and one fund. The only real slight difference here, to be honest, is that the ongoing costs are slightly more at 0.22% on this fund. So if you add the 0.22% to your account fee at 0.15%, you still get an extremely respectable 0.37%, which if you look at any other platform is extremely competitive and very, very cheap indeed. If anything, Vanguard tend to reduce their charges rather than increase them. Does this additional cost really make a huge amount of difference? Well, in all honesty, not a huge amount. There's a huge difference to be made when, for example, you might have a 1% or a 2% fee, but once we get down to these 0.3s and 0.28s, for example, there's really not much in it. But let me give you an example anyway. So let me just go through this example that I've got ready here. If we had £100,000 invested over 10 years and we got exactly 10% interest per year, we won't pretend we got any fees at all, our investment would then be worth £270,704. If we say that our fees were 0.09%, which is the difference between our 2-fund portfolio and our single fund portfolio, here's what we'd end up having. We would end up having £268,298. So over 10 years, which is a huge period of time, our fees would have cost us £2,500. So that breaks down to about £250 a year, or around 20 quid per month. So in the long run, those kind of differences don't really make a huge amount of difference, and to be honest, it's probably best spending more of your time trying to work out how you can plow more money into your investments each month, increasing your quality of life, increasing income from your job, increasing income from side hustles, and if you can make any savings, great, but knowing that you can potentially just invest a single cost every month and not have to worry about balancing a portfolio of multiple funds, you can get around with just one fund that will sort you out for life at a really, really low price point. Remember, I am not a professional financial advisor. I'm not qualified to give you financial advice. This is just an option I've put together. It's just my opinion. Please make sure you do all of your own research, but I'd be keen to know what you think. Let me know in the comments below. Now, with all this great stuff being said about investing in the world, what are the downsides? Because we've got hard-earned British pounds here, and we need to work out how we can stretch them as far as we can. The biggest red flag here is currency. We're from the UK, not the US. We can't just invest our dollars. What are we doing to invest our pounds, and how are we protecting those? Don't worry, I've done the research. I've thought long and hard about this one. So you'll hear this loads and loads across the finance community on YouTube, especially from those based in the US, who will say, you just take your money every month, you invest in the S&P 500, set and forget, and that's all you need to worry about. Well, that's really great advice when you're investing in dollars, but of course, us from the UK have got our hard-earned pounds, and of course we do get affected by any price currency fluctuation. So now I'm not going to be betting against the US market anytime soon, but we do need to work out how we can make our UK pounds go a little bit further. Now remember, of course, as the US economy grows, and it might grow 10%, but what if the rate of exchange to the dollar drops 10% and our pound weakens? Well, then we've just zeroed ourselves out. So in theory, I might want to invest in our home market, the UK, because that would make sense for my pounds. I would buy shares based on pennies and pounds rather than dollars. That makes a lot of sense. And this is commonly known as the home bias, because of course we invest our money in the place where we actually live, and we understand the stock market, and we understand the brands on the stock market as well. Remember we said earlier that the UK actually accounts for about 4% of the global economy. So in theory, if we want to have a bit of home bias, we would potentially put a little bit more money into the UK. However, it's not as straightforward as you think. So think of who makes up the FTSE 100 and some of the biggest companies in the UK. The profits from the biggest companies in the UK don't actually come in pounds. So bear with me here, but most of the companies on the UK Stock Exchange actually make their profits abroad, and they make their profits in dollars, Chinese yuan, and euro. So sure, they convert those profits back into pounds, but over 70% of their profits are actually generated in other currencies than the native pound. So unfortunately, there's not really much we can do here, and we can't really escape that currency fluctuation. You'll see this happen when the pound actually weakens. The FTSE 100 tends to rise because their profits are actually worth more and we've done nothing at all. So is there any way really around this? Well, my only thoughts really would be that you have a very nicely globally diversified portfolio, because at the end of the day, the global economy is so interconnected now, and ultimately it doesn't really matter whether a company is based out of the US or the UK. A lot of these companies have customers everywhere and rely on customers everywhere. They don't really care where you're based. And what about the argument against putting the weighting of our investment due to the size of the market today? Well, what about the market weightings in the next 10, 20, 30 years? Well, it's a valid point. As investors, we can't predict necessarily which market is going to boom over the next 10, 20, 30 years. Is the US going to hold the #1 spot? Is the UK finally going to make a resurgence, or are emerging markets going to absolutely boom? I think my opinion here is to not bet against the US one bit. And if you look at what makes up the US stock market and what makes up some of the biggest companies in the world, it's all based on tech, communications, and extremely disruptive technologies. And if we've seen anything over the past few years, I think the disruption caused by technology and the evolution of the way we work is going to change dramatically over the next 5, 10, 20 years. And I think technology is going to be the driving force behind that. And of course, all the supply chains and all the other markets around the world are going to evolve, and they're going to benefit from this too. But my personal opinion would be to not bet against the US and keep investing your money depending on those market sizes. And of course, if we get a little bit exposure to emerging markets in the UK and we get some growth from there, great. But I think if we keep our ultimate portfolio based on the market weights as they stand currently, I think we'll put ourselves in a pretty good position. Remember what I said, I'm not a financial advisor, I'm just some guy on the internet, it's just my opinion. So let me know in the comments below what you think about that and what you would do. So in summary to this video, I've given you two different ultimate options for your Vanguard portfolio. You've got one which includes two funds and one which includes a single fund, which for the majority of people who just want to invest month after month without having to go through and read up about individual stocks, this could be a really, really nice place to start, a great place to invest, and a set and forget style portfolio they can just keep an eye on every now and then to make sure they're on the right track and spend more of their time worrying about things that matter in life and investing consistently month after month. You'll have global exposure, of course, from both the developed market and the emerging market, so almost nothing is off the table, and you won't have to worry about doing any fine balancing between yourselves or which companies are doing well and checking the news one day to see which company's gone bust. And finally, remember what I said earlier, that these funds can actually be traded on other platforms too. So if you look out for the ticker symbols that I've mentioned earlier, like VWRL, VEVE and VFEM, you can actually find them in all the different trading platforms like Free Trade or Trading 212, for example. Free Trade, I've got a link in the description below. We both get some free stocks if you want to invest and you were going to go and do it anyway. I'd really appreciate that, and you can help out the channel. And you could potentially even get them cheaper, because a platform like Free Trade, for example, if you don't want to use a stocks and shares ISA, you can invest completely free. But if you want to invest in a stocks and shares ISA, then it's just £3 a month. Once you build up a nice portfolio, you can actually end up saving yourself a huge amount of money. And for full disclosure and full transparency, at the moment I've just got a very small holding in Vanguard, just at £500, tracking an S&P 500 fund. I am looking at my investments at the moment because they are a bit of a mixed match of things, and I am potentially going to reduce all of my investments down to a couple of different index funds, because ultimately in the long term, I know that they'll perform extremely well, and it means I have to less worry and less care about individual stocks and shares. But let me know what you think in the description below. Have I covered any points in this video? Have I missed anything, for example? If you've enjoyed the video, drop me a like. It really helps get this video out to more people. Subscribe for more, and I'll see you guys in the next one.